And for the emerging growth markets, that's not some technical change buried in the SEC release. That's real access to capital for everyday companies. And frankly, it's exciting to think about what this could mean for the emerging growth markets and for all small public companies. Have you ever wondered what's really happening inside the emerging growth markets? Or why some companies are able to get public, raise capital, and grow, while others just struggle to get through the process? Welcome to Inside the Emerging Growth Markets. I'm Joseph Lucosky, managing partner of Lucosky Brookman, Wall Street trained, founder focused, and for the last 2 decades, I've advised hundreds of the most ambitious and committed entrepreneurs, investment bankers, and investors across some of the most active and dynamic parts of the capital markets. Whether you're preparing to go public, navigating life as a public company, or operating inside the emerging growth ecosystem, this briefing is for founders, public company leaders, and other capital markets professionals who want to understand how this market actually works today. My goal is simple: to give you a real, clear-time view of what's happening inside the emerging growth markets, and more importantly, what you should be doing about it. In each episode, I'll break down what we're seeing from the trenches, from IPOs to uplistings and direct listings, to reverse mergers, SPACs, secondary offerings, and the ever-evolving regulatory landscape, so you can make better decisions and execute at a higher level. If that sounds good to you, then listen in, because in this market, understanding how it really works can make all the difference.
My name is Caroline, and welcome to Inside the Emerging Growth Markets with Joseph Lucosky. On this show, we take some of the most current and pressing questions on the minds of those of you in the emerging growth and microcap ecosystems and break them down in a live question and answer format for Joe to give you his take from the trenches. I'm really excited for today because we're doing something a little bit different. We're going to be taking you inside of Washington. As many of you know, Joe is a member of the SEC's Small Business Capital Formation Advisory Committee. The committee meets through the year to examine some of the most important issues affecting smaller public and private companies and makes recommendations to the SEC. Those meetings are public and incredibly substantive, but they're also several hours long, and most founders, CEOs, boards, investment bankers, and other market participants simply just don't have the time to sit through an entire meeting. So periodically, we're going to do that work for you. After these meetings, we'll take you inside of Washington to break down what was discussed, where some of the real debate occurred, what recommendations came out of the committee, and most importantly, Joe's perspective on what all of it could mean for companies operating in the emerging growth markets. And Joe, there was a lot to unpack from this meeting, so let's start at 30,000 feet. What was your biggest takeaway coming out of Washington?
Well, Caroline, I think we're potentially looking at a once-in-a-generation reform of our public capital markets, particularly for smaller emerging growth companies. And I don't think that's an overstatement. The basic objective is pretty straightforward. How do we give companies greater access to capital and make it more cost effective for them to raise that capital, and also reduce some of the unnecessary bureaucracy that comes with being a public company?
And that's where you think all of this is headed?
Well, the SEC itself has described the registered offering proposal as the most significant modernization of that framework in the last 20 years. So when you step back and look at everything that we've been discussing, I think there's a much better or bigger theme here. And that really is, how do we get more good companies to go public, give them better access to capital once they are public, and create an environment where they actually want to stay public, or that they can stay public? That's really the headline for me coming out of Washington.
Okay, so that's a pretty big statement. I mean, what were you actually talking about in the room?
Well, we spent a lot of time primarily in 3 areas. The first was registered offering reform, and that's the biggest one we've talked about, and I think that's what everyone really knows. And that is whether we can make it easier and more cost effective for smaller public companies to access capital, specifically registered capital, mainly around Form S3 short form registration rules. We also looked at the current filer status framework and whether having 5 different categories really still makes sense. And if we can simplify that down to essentially 2 categories with a little carve out of one of those categories for smaller non-accelerated filers. And finally, we talked a lot about and really had robust debate around this quarterly versus semi-annual reporting. I mean, that was the biggest debate we had the entire time, and I think that is what produced the most amount of comments from the people that wrote in. Now, those sound like three completely regulatory issues, but I don't believe they are.
Why do you think that?
Well, because they're all really asking the same version of the same question in my mind. And that is, have we made becoming public and staying public more complicated and expensive than it really needs to be? And that's what I found that was so interesting in the discussion. I mean, we're talking about how companies raise money and really what regulatory bucket we put them in once they're public. And then we're also talking about how often we should require them to report. So when you put all that together, this isn't just tinkering around the edges that the SEC is, putting forth some new rules. We're really asking whether parts of the regulatory architecture that we live and die by every day and that was built over decades still make sense for our public markets that we have today.
And I assume there's another side to all of this because every time you reduce a regulatory requirement, somebody is going to be asking what happens to investor protection. Is that right?
Absolutely. And that's why these conversations are so important in my mind. There are legitimate arguments on both sides of these issues. And we'd had some really healthy debate around them, especially, again, like I said, the quarterly versus semi annual reporting. But I also want to be careful here because these are proposals that are being considered and debated. Remember, I'm not suggesting that I know where the commission ultimately will come down on any of these rules. I am just in the room having a good, robust discussion. And what I can do is tell you what we discussed publicly and explain why I think this stuff matters, especially for the emerging growth ecosystem.
So then let's take them one at a time and start with registered offerings. You did say that one of the big themes coming out of Washington is making it easier and less expensive for public companies to access capital. So what's broken with the system that we have today?
Well, I don't know if I think the system is broken, but I do think the system has become unnecessarily complicated and probably too expensive, particularly for smaller public companies. And this is one of those areas where I think size really matters because if you're a large, seasoned public company, you generally have tremendous flexibility to access the capital markets quickly. But if you're a smaller company, an emerging growth company, you generally have a completely different experience. I mean, you may be using long form S1 instead of short form S3. And even if you're eligible for the short form rules, there are significant limitations on how much capital you can raise, particularly if your market cap is below $75 million. dollars. And when you're running an emerging growth company and you need capital, time really matters.
Okay, but can you just help me understand this from the CEO's perspective? I mean, why should the CEO care whether the lawyers are using an S1 or an S3?
Well, that's actually a really good question because the CEO probably doesn't care what number is on the form. In fact, I don't care what number is on the form, but CEOs do care about how quickly they can access that capital and how much they can raise and really what it's going to cost them to get that capital. And that's where this S3 short form registration conversation becomes really important. Think of the S3 as giving an eligible public company a much more efficient way to keep securities registered and access the capital markets and raise capital when the opportunity arises.
But there is still a catch for smaller companies today, right? You've mentioned this $75 million number a few times now. Why does that matter so much?
Well, because that's where it gets particularly important for emerging growth companies, especially the ones that we represent and we see in the market. Remember, under the current rules, there's a $75 million public float threshold. And if you're above it, you're otherwise eligible for S3 and you can really raise the full amount that you have on your shelf registration statement. But for most companies, if you're below it, Caroline, you can fall into what's commonly called the baby shelf limitations. And we don't have enough time to get into all the ins and outs, but suffice it to say, there's a formula under the baby shelf rules that can really restrict how much capital you can actually raise.
So, give me an example because I think this is one of those things that sounds technical until you actually see the numbers.
Yeah, sure, Caroline. I think that's a good idea. Let's say you have a $50 million market cap, but 20 million of that is held by affiliates. So, really, your public float under the calculations is approximately $30 million. Under the baby shelf rules, you would then generally be limited to selling securities equal to one third of your public float over a 12-month period, generally speaking. So, in this example, one third of $30 million, which again is your public float, is about $10 million. That means even if you have a company that has a $100 million S3 sitting on the shelf, as we say, it generally can't go out and raise the entire $100 million. It's limited by the baby shelf rules. So in this case, it would be limited to $10 million over a 12-month period. Now, there's some other calculations and look backs that you might be able to get some additional capital in that 12-month period. But for the most part, you understand the concept. And this is really an artificial limitation anyway. So that's a huge difference and huge barrier for emerging growth companies that are trying to access capital. And I'll also say these are the companies that require the capital the most.
Okay, so now I understand why eliminating that $75 million threshold is such a big deal.
Yeah, it could be enormous, Caroline, and I don't think we should understate it. Remember, the SEC is proposing to eliminate Form S3 transaction requirements, including the $75 million public float threshold. So instead of having this artificial dividing line where one smaller public company has significantly less access to its shelf than, say, another company, a much broader group of companies could potentially have access to the full amount that they register. And that's the point. The SEC estimates, I think, that under this proposal, if it's passed, it could increase by more than 60% the number of issuers eligible to offer an unlimited amount of securities on the short form S3 registration. And for the emerging growth markets, that's not some technical change buried in the SEC release. That's real access to capital for everyday companies. And frankly, it's exciting to think about what this could mean for the emerging growth markets and for all small public companies.
So give me the real world version. I'm running a smaller NASDAQ company. What could this actually change for me?
Well, it's going to change a lot. Let's think about it this way. Maybe your stock is trading well right now, or maybe you have an acquisition opportunity, or if you're a biotech, you want to accelerate a clinical trial. I mean, the reason doesn't matter. Whatever it is, the basic point is the same. For an emerging growth company, capital market windows can open and close very quickly, as we know. And if you already have a shelf registration statement in place and you no longer have to worry about this artificial $75 million threshold. You potentially have much greater flexibility to access that capital when the opportunity arises. Remember, those market windows open and close very quickly. So capital doesn't always show up when it's convenient for the company. Sometimes the opportunity is there on a Tuesday, and then by Friday, it's gone. That's why I think this matters so much to the smallest public companies who have the greatest need for access to capital.
Okay, Joe, but I watched the entire meeting and there was one part of the registered offering discussion where you seemed pretty passionate. The committee had a pretty vigorous debate about the penny stock exclusion and what it could mean for companies trading on the OTC. What was bothering you so much about that?
Well, I'm not so sure that it was bothering me. I do believe, though, that it's a really important part of the proposal. And I'm so glad that you brought it up because you're right. I did spend a significant amount of time talking with my colleagues on the committee about this issue. Remember, I am very supportive of the registered offering reform overall. I think the SEC has put together a great package that we're now discussing, and I think it could be transformative for so many smaller public companies. But there is one point or one part of it really that I do think we need to fix or at least have a better discussion about. Currently, under the proposal, as I said at the meeting, the expanded S3 eligibility would still have restrictions for companies that fall within the technical definition of penny stock rules. And that's really important for companies, especially those trading on the OTC markets or that were trading on NASDAQ or the New York Stock Exchange and now are forced to trade again on the OTC.
Why? I mean, what makes the OTC companies different here?
Well, I think my point is really this. There are hundreds of companies trading on the OTC that are fully reporting with the Securities and Exchange Commission, and they file their 10Qs. They have audited financial statements. They file their 10Ks. You know, they are a real Exchange Act reporting company. But many of those companies would be excluded under these reforms. The way the rule is currently proposed, because they technically fall within the definition of a penny stock. And that's really where I have the problem. A smaller company trading on NASDAQ or the New York Stock Exchange might otherwise fall prey to the penny stock definition. But as we all know, there's an exemption for those companies because they are on an exchange. They are exchange listed. So now what we're saying is the platform where the company trades can have a significant impact on whether it can access this capital. And all I'm saying is it should be tied to their level of disclosure and transparency, not tied to their platform.
Okay, but let me push back a little bit here because there are legitimate investor protection concerns around penny stocks. Liquidity can be an issue. We all know the history. Why shouldn't the SEC treat those companies differently?
Well, that's a fair point, Caroline. And a lot of my colleagues on the committee brought that up. And I respect that point. And actually, liquidity was one of the other things that I think people raised during our discussion. And I'm not suggesting we throw away investor protection or throw that out the window. But if liquidity is the concern, then we can address that in other ways. But if reporting compliance is the concern, let's address reporting compliance. What I don't think we should do is automatically assume that a fully reporting audited company shouldn't have access to the same capital formation reforms simply because it trades on the OTC. These are two very different issues. And Caroline, there's a bigger issue here that I think we really need to start talking about because the exchanges play a significant role in all of this.
Okay, and what do you mean by that?
Well, NASDAQ has made it significantly harder for companies, especially smaller companies, to get listed, particularly with all of the new reforms that have come out over the last year. And we all know that the big one was in December 2025, the discretionary rules. We are also seeing continued pressure on these small companies from NASDAQ and the New York Stock Exchange to some degree, but it's a little bit different, to maintain their listings. So, in sum, the exchanges are passing rules and implementing new regulations to make it harder to list and harder to stay public. So think about what that is doing. We're making it harder for these smaller companies to get to Nasdaq, and we're making it harder for them to stay on Nasdaq. And then if they get delisted down to the OTC, now we're potentially saying it should have even less flexibility to raise capital that they so desperately need to grow. So who are we actually helping in this scenario?
Yeah, that's interesting because the company itself hasn't necessarily changed.
Right. I mean, nothing has changed. Think about it. On Monday, a company is listed on NASDAQ or the New York Stock Exchange and potentially has full access to their capital raising tools. And then on Tuesday or Wednesday, it gets delisted and begins trading on the OTC. Now we're saying, even though it's the same company, the same business, same financial statements, basically the same everything, now we're saying that their exchange exemption is gone. They may now qualify as a penny stock and they can't take advantage of these reforms that can really so dramatically change their world and the world that they live in this smaller, company regime. That's the disconnect that I'm really talking about.
So, is the bigger problem here that there's almost a missing rung in the public markets?
I think there may be. And frankly, this is something I've been thinking about a lot and I've had a number of discussions. Maybe what we're exposing here is a much bigger structural problem in the emerging growth markets inside the United States. Because I am convinced that NASDAQ has made it pretty clear through its recent rule changes that it wants higher barriers to entry and really stronger continued listing rules for smaller companies. And that's fine. But those companies just don't disappear. Where are they supposed to go? I mean, right now, you basically have senior exchanges on the one side and you have OTC markets on the other. Maybe what we're missing is somewhere or something really in between. Maybe we're missing a true venture exchange like they have in many other countries.
And what would that look like?
Well, I think a regulated national securities exchange designed specifically for smaller emerging growth public companies could be a good thing. It would have to have strong investor protections, of course, and there would have to be meaningful listing standards. I mean, they would have to work through that process. But the rules that are actually designed around companies at the right stage of development, because right now there is a huge gap in the market. And I think this registered offering reform proposal is really exposing it in ways that I'm not sure a lot of people have thought about.
Didn't somebody at the meeting describe part of this as almost a chicken and egg problem?
Yeah, I thought that was a really good point. Another one of my colleagues said that if one of the problems with these companies is limited liquidity, but then we make it harder for them to raise capital and potentially get more securities into the market, aren't we actually contributing to the problem that we're worried about? And that's really worth thinking about because remember, what we're trying to accomplish here, or really what we're talking about, is expanding access to capital for all of these smaller companies. It would be pretty ironic if we did that while excluding many of the companies that have the hardest time accessing capital in the first place.
So this wasn't just a discussion. The committee actually did something about it, correct?
Yes, we did. The committee ultimately recommended that the penny stock status should not automatically disqualify a company from the expanded S3 regime if that company is current and compliant with all of its SEC reporting obligations. And I really do support that.
But you also said the reverse is true. What did you mean by that?
Well, think about the same company I just described. One day it's listed on an exchange and potentially has access to all of these great capital raising tools. If we're trying to help smaller companies become, much larger companies, how does making accessing capital harder for these companies at precisely the point in time when they need it the most accomplish that goal? That's really the bigger policy question for me. I'm a huge supporter of this registered offering reform. I've said it many times now, not just here with you, but in other public forums. You've already heard me say that I think how significant it is, especially limiting that $75 million baby shelf limitation. That's why I really want us to get this part right. If we are talking about a once in a generation reform, I mean, really a once in a lifetime reform, let's make sure that we aren't unintentionally leaving behind hundreds of legitimate, fully reporting smaller public companies simply because they trade on the OTC instead of NASDAQ or the New York Stock Exchange. If they are fully reporting, fully audited, they comply with all of the same rules that these other companies do on the national exchange, then why shouldn't they have access to the same capital that the exchange companies have?
So you're not arguing against the reform, you're actually just arguing that it should go further.
Yeah, that's right. Keep the investor protections that we spoke about earlier that actually protect investors. Nobody's saying we should change any of that, but let's make sure that we're not creating arbitrary barriers that prevents legitimate small companies from accessing the capital that they need. And maybe we're also need to start thinking or maybe asking the bigger question about whether the structure of our markets still makes sense for the full life cycle of an emerging growth company. Because if we're serious about helping smaller public companies access capital and grow and ultimately become larger public companies and be more successful public companies, then there has to be somewhere for them to grow up. And really that's all I'm saying. To me, that's what good reform should try to accomplish.
Okay, so let's now move to the second big issue that you discussed in Washington, filer status. And I'll be honest, this sounds like one of those topics that only securities lawyers could possibly get excited about. Can you tell us why anyone else should care?
Well, that's actually a really funny statement, Caroline, because I get it. Filer status doesn't exactly make you want to stop what you're doing and listen to a podcast. I completely understand. But what it actually determines is incredibly important. It really does affect things like how quickly you have to file your disclosure reports and what disclosures you really have to make or provide, and whether or not you're subject to certain maybe internal control requirements. So underneath that pretty boring name are some really, really important costs and obligations for public companies.
And how complicated is the system today?
More complicated than I think it really needs to be. Today, we have five partially overlapping categories, and I'll maybe name them real quick if I can remember them. But there's large accelerated filer, then it's accelerated filer, non accelerated filer, and then there's smaller reporting company and emerging growth company. I mean, lots of even lawyers don't even know what companies fit into these categories. And depending on the company, you may actually fall into one or more categories and have different requirements or even accommodations depending on which rule you're looking at or which attorney you're talking to. So suffice it to say, it's pretty complicated right now.
So, what's being proposed?
Well, that's where it gets really exciting because the proposal would significantly simplify this framework and essentially move us towards a two category process, really two principal categories: large accelerated filers and non accelerated filers, with a small carve out for what we're going to call the non accelerated filer framework. And that's really for the smaller reporting companies. And here's the other thing, it would also increase the public float threshold for becoming that large accelerated filer where you have so many other reporting requirements from 700 million, where it currently is now, all the way up to $2 billion. And generally, you wouldn't have to move into that category until you've been reporting for at least 60 months.
Wait, from $700 million to $2 billion? I mean, that's not exactly tinkering around the edges.
No, it's not. It actually is real reform. And here's the number that really jumped out at me. If these rules were in effect today, the SEC estimates, by their own numbers, by the way, that approximately 81% of public companies would be non accelerated filers. Think about that. This isn't just a narrow accommodation for a handful of, micro cap or emerging growth companies. You're potentially changing the regulatory framework for the overwhelming majority of public companies that exist today.
Okay, but you were actually in the room debating this, so where did the discussion start to get interesting?
Well, one area that we had a really, really robust discussion about was around the smaller reporting category, and that is really the non-accelerated filer status. The proposal uses right now a $35 million asset test, and that's where a lot of discussion was about. Is $35 million assets really the right number? Some thought it should be higher, and there was discussion about potentially moving it up to 50 million. But underneath it all was, I think, a pretty basic question, and that is, how do you actually define what a smaller public company is in 2026?
Why assets and why not revenue?
Well, that came up too, actually. And there was a lot of discussion about whether revenue should be part of the test. But again, I think that's where it really gets complicated. And some of my colleagues on the committee really made a good point, and that is, revenue doesn't really mean the same thing across different industries. Take biotech, for example. It can have very little revenue and still have significant value, significant assets. It could have significant capital needs. Compare that to maybe a more mature operating company where revenue may be a much more meaningful measure, let's say. So a revenue test sounds simple until you actually start applying it across different industries.
So, where do you come out? Is the $35 million enough?
Look, I think that's the right question. I'm very supportive of simplifying the filer status framework. I think that's an important goal. But if we're going to create a special category designed specifically for smaller reporting companies, then we should make sure that threshold actually reflects what a smaller public company looks like today. So whether the right number is 35 million or 50 million or something else worth debating, that's fine. What I don't want us to do is undertake potentially, again, once in a lifetime or generational reform and build that new framework around a threshold that is really too restrictive on day one.
Yeah, so that all sounds really great, Joe, but you didn't answer my one question. Is $35 million enough?
Okay, Caroline, you caught that, huh? You're supposed to be nice to me, I thought. I'm just kidding. Well, I am supportive of the current proposal at 35 million, but I actually think the number should be higher. I would be supportive of a $50 million threshold, although I am, again, supportive of the rules as they currently exist.
Why? What gets better at 50 million that you don't get at 35 million?
I just think it captures more of the companies we're actually talking about when we say smaller public companies. $35 million in assets is a pretty narrow universe. If the objective is to meaningfully reduce unnecessary burdens on smaller issuers, I think we should be careful not to draw the line so low that a lot of the companies we're trying to help may fall outside of it. I'm not wedded to the $50 million either. It's not some magic number, but I do think $35 million is too low. Now, the data that I believe the SEC has put out says that it would only increase the amount of companies by about 4%. So maybe that's not extraordinarily meaningful either. But from my perspective, 50 million just seems like a better number.
So ultimately, this comes back to the same theme that we started with.
It does. And we're really trying to figure out where regulation provides meaningful investor protection and where the cost and complexity may have become disproportionate to that benefit. So that doesn't, always find an easy line to draw. And frankly, I think these debates are really, really important.
Okay, now let's get to the third big issue. And from what you've told me, this may have been the most hotly debated of the three: quarterly versus semi annual reporting. What is actually being proposed here?
Well, you're right. This one has generated a tremendous amount of tension from the industry and really beyond. And the proposal itself is actually pretty straightforward when you read it. Today, public companies generally file three quarterly reports on Form 10Q during the year, and then they file their annual report on 10K. I think everyone pretty much knows that. What the SEC is proposing is to give companies another option. So a company could elect on a voluntary basis to file one semi annual report on something called a new Form 10S, S is in Sam, along with its annual report, instead of filing three quarterly reports. And Caroline, the key word here is optional.
And why is that distinction so important?
Because I don't think anybody is saying that companies should be prohibited from quarterly reporting. And certainly in our committee discussion, there was a lot of support for giving boards and investors the flexibility to decide what works for their company or for their industry. Where I think you would see much more of a concern, particularly in the emerging growth markets, is if semi annual reporting became mandatory. That to me would be a problem and would be a very, very different conversation than the one that we're currently having.
Okay, so what's the argument for giving companies the choice then?
Well, I think cost is certainly part of it, but there's also management time. Think about it for a smaller public company. And frankly, this is the story I hear all the time from founders and management teams. I mean, tell me if you've heard this story before. You close the quarter, you prepare the financial statements, and you have all these discussions with your auditors and your lawyers, and you prepare the 10Q, and you go through all these meetings and board approvals, and then finally you make the filing. And that process takes about 45 days generally, and maybe 50 or a little bit longer if you're on extension. And then almost immediately, you have to start that process all over again. And for small management teams or small companies that don't have a tremendous amount of resources devoted to compliance, that is taking time away from executing on the underlying business. So I understand the argument for giving companies the flexibility needed to choose because it is a drain on resources.
But I mean, there's clearly another side to this. 6 months can be a very long time for a smaller public company, right?
Yes, it's actually a very long time, and that's why it's generated, I think, such robust debate. The United States, remember, has the deepest and most trusted capital markets in the world, in part because investors expect transparency. And in the emerging growth markets, I think that matters even more. I mean, let's be candid. Our part of the market doesn't always get the best reputation. So I think we should be very careful about doing anything that could be perceived as giving investors less transparency.
That's interesting. I mean, because you're generally arguing throughout this episode and in general for reducing unnecessary regulatory burdens. But on this one, you're saying maybe emerging growth companies should keep the burden?
Well, I wouldn't quite say it that way. I do support giving companies the option, that is for sure. I think boards and their investors should be able to make that decision. But if you ask me what I would generally recommend to an emerging growth company, I would still say file quarterly
Why?
because I think emerging growth companies should always act like they're trying to get to that next level. And I think investors expect quarterly reporting. If you want better investors or you want better institutional ownership or research coverage or even better liquidity, then you want the market to take you seriously. And I just think that if you're asking investors to trust you with their capital, I don't think your first instinct should be how little information am I required to give the market? I think it should actually be the opposite. How do I build enough credibility that investors want to own my company for the long term?
So the SEC may give companies permission to report less frequently, but you're saying that doesn't necessarily mean they should?
Yes. And I think that's the real takeaway here, Caroline. Regulatory permission and good corporate judgment aren't always the same thing. There may absolutely be companies where semi annual reporting makes sense. Different industries or different shareholder bases, especially maybe closely held companies, different stages of development. That's why I like the optionality. But for most emerging growth companies, my bias would be towards greater transparency, not less. And I think the companies that embrace that mindset are ultimately going to separate themselves from the ones that don't.
And semi annual reporting wouldn't mean investors hear absolutely nothing for 6 months, correct?
That's correct. That's another very important distinction. And thank you for bringing that up because companies would still have disclosure obligations when material events occur. Form 8K isn't disappearing, and companies could still communicate with investors through earnings releases or press releases or other appropriate disclosures. That doesn't mean that there's going to be radio silence for 6 months. The real debate, I think, is whether the SEC should mandate full periodic reports every quarter or whether boards and investors should have some flexibility to decide what reporting cadence makes sense for their company and their industry. And I think that's the debate worth having.
All right, Joe, we covered a lot: registered offering reform, a major simplification of filer status, and potentially giving companies the choice between quarterly and semi annual reporting. But when you step back from all of it, what would you say the bigger picture is?
I think we are potentially looking at a significant modernization of our public markets, particularly for smaller and emerging growth companies. Different proposals, but really we're moving in the same objective. And the question still in my mind remains the same. How do we make the public markets more attractive and more workable for the next generation of companies? How do we make it easier for good companies to raise capital? How do we make it easier to reduce unnecessary costs and bureaucracy once they're public? And how do we make it easier to maintain those investor protections and transparency that really make our markets work? That's the opportunity I see with all of these reforms and proposals.
At the end of the day, these are still proposals, so what should companies be doing right now?
Well, I think the first thing they should do is continue to pay attention because none of these rules are going to change tomorrow. There's still a public comment process, and there will definitely be more debate and more discussion. And then ultimately, the commission is going to have to decide what gets adopted and in what form it should get adopted. So, companies shouldn't operate as though these rules are already in effect or even going to go into effect. But I'll say this: if you're a CEO or a CFO or a board member of a public company, you should absolutely understand what the debate is about, what's happening, and how these changes could potentially materially affect the economics of being a smaller public reporting company.
So you've used the phrase once in a generation reform, but after sitting through the meeting and hearing the debate, do you still believe that?
Yes, I think we have a tremendous opportunity. And I want to choose that word carefully because we're asking questions that haven't really seriously been asked in a very, very long time. And the questions in my mind are really, are we making it too difficult for smaller companies to raise capital? Are we making it too costly to comply with the disclosure requirements without a real corresponding benefit? And are we creating a public market system that good companies actually want to enter and stay in? Those are the big questions in my mind. And I'm glad we are starting to ask them and discuss them and debate them both inside, outside the committee.
Okay, before we let you out of Washington, let's do something that we're going to make a regular part of these quarterly updates. What are you watching between now and the next meeting?
Well, I think there are three things I would probably focus on. First, and this is the big one, of course, registered offering reform. Really eliminating that $75 million baby shelf limitation will have an enormous practical impact on the emerging growth companies. And I'm really also very carefully watching what happens with that penny stock exclusion and the OTC markets that we discussed. Secondly, I think I'm going to keep my eye on where the smaller company threshold lands. We talked a little bit about that 35 million versus 50 million asset versus revenue test. I think that's really important. Again, I'm very supportive of 35 million. I would like to just see it a little bit higher. And then third, that semi-annual reporting category, the question for me is not simply whether companies are given the option, but really what boards and investors will actually do if they are granted that option. Because sometimes the most interesting part of the regulatory reform isn't really what Washington or Congress permits, it's what the markets decide you should do, or in some cases, will force you to do.
We'll come back to all of this when we do our next Inside Washington update.
Absolutely, Caroline, because if we're really at the beginning of a significant modernization of the public markets, I want our listeners to understand what's happening as it develops, not 6 months later after the fact, after everyone else is talking about it, but really right now in real time. Understand what's going on so you can make better decisions going forward for your company.
Joe, this was a great discussion, and I have to say, I wasn't sure that filer status and SEC reporting requirements were going to make for a very exciting episode, but there definitely is a lot happening here.
Yeah, there really is, Caroline. And I think that's the real takeaway because for smaller reporting or emerging growth companies, greater access to capital, lower costs, less unnecessary bureaucracy, I believe will make a real difference in the lives of these companies. But less regulation isn't automatically better regulation. Remember, we still have to balance capital formation with transparency, investor protection, and really good corporate judgment. So if we get that balance right, I think there is a tremendous opportunity here to reform again, once in a generational reforms for our emerging growth ecosystem.
And we'll keep following it. We'll be back after the next meeting with another Inside Washington update and let you know what's changed, what's moving, and what Joe is watching. You've been listening to Inside the Emerging Growth Markets with Joseph Lucosky. For more insights from the trenches of the emerging growth markets, follow Joseph Lucosky on LinkedIn or subscribe to him on Substack. And if you found this episode helpful, please share it with someone in the market. And remember, if you have any questions, please send them to us at questions@lucbro.com. That's questions@lucbro.com. Thank you for listening, and we look forward to next time.